We did learn today GDP expanding at a slower pace than initially estimated in the fourth quarter. Weather is believed to have played a role, but what's the rest of the story?
Well, net exports actually fell, and as well as consumption, and weather played some role. But it's interesting to note that the services component of GDP actually has been growing faster than it's been in recent quarters. So services grew at 2.2% for the quarter. They've been growing at under 1% for the past couple of years, and they actually make up the largest part of consumption. They're 70% of consumption, so 50% of growth is actually from services, and seeing those services growing at a 2.2% rate is actually quite a good underlying place for the economy to be.
Joseph, the markets seem to shrug off that GDP news in large part because consumer confidence is on the rise, and also because Fed Chair Janet Yellen indicated Thursday policymakers aren't stuck to a firm reduction of monthly asset purchases. Why do you think consumer confidence increased in December? What might it mean for future spending?
I think there's often a lag in the effect of house prices and housing conditions and stock prices on consumers, and there has been gradual improvement in the labor market, which also has a lagged effect. So I do think that these things just sort of build over time. So I'm not surprised. I think the Fed is optimistic for a good reason this year, because we don't have big tax increases or spending cuts like we did last year. So it creates a much better climate.
And as the Fed has pointed out, they're still engaging in very loose monetary policy. They're just simply taking away the extraordinary measures. They're not raising rates. And they've been very, very clear with their forward guidance that rate raising is going to be a second phase, which isn't even going to start until 2015.
Well, if the Fed does change its taper strategy, how quickly can policymakers make that pivot?
Well, if they change its taper, there's two ways they could change the taper. They could slow the amount of tapering. They could take it from 10 billion to 5, or take it to 10 billion to 0, or they could actually reverse it and start adding. Now, they can do this whenever they want. They could have an intermeeting event. It's unlikely that they would do that. They would probably do it at a meeting. But they can do it whenever they have a meeting, and really, as I said, whenever they want. Although I really think that they won't do an intermeeting move. But if we had an extreme event in the economy, they might do an intermeeting.
Joe, that Fed taper strategy. I'm sorry, go ahead.
Oh, I was going to just say that I think it's interesting to note that although the Fed and the markets may have similar views about the taper and interest rates going forward, the Fed's a bit more optimistic about the economy. So if the economy does weaken, and this turns out not to be just weather, I very much think that you could see a halt in the taper, and that might catch markets by surprise. There was a bit of that flavor today in today's market reaction.
Well, what effect might that have on Main Street then?
Well, it just shows that the Fed is not out of the game yet, that if the economy needs the Fed to come back, I think they absolutely will.
Joe, back in December, you wrote an op-ed for USA Today, and it read in part, and I'm quoting here, "For the 5th time in less than 5 years, the Fed has jumped the gun in starting to scale back its support of economic recovery." But as you know, inflation's still below target, and unemployment is still falling. I would not have done what the Fed did in December, because I would have wanted to have solid data in hand, and today's report only confirms that. I think it was a bit premature, but they are moving slowly. And I do remain optimistic about the underlying economy, as Constance said. I think that the fundamentals are there for a good year this year once we get past weather and the choppiness in the data, but we'll have to see. Constance, you also wrote something as well, Bloomberg View, 10 days ago. You wrote about disinflation. You likened it to kryptonite to central bankers. What are the main disinflationary warning signs that you're seeing right now?
Yeah, well, it's kryptonite to central bankers because it's not something that they have that much power to do much about once we get a disinflationary cycle in place. So we're seeing lower price increases month over month, and that's what tends to cause disinflation. But the other worrying thing is that all of our trading partners have very, very low levels of inflation. So if you look at Europe, we're under 1%, Canada under 1%. Japan has just gotten its inflation up to its 2% target, but look at what it's had to do to its currency in order to get there.
Yeah. Joe, today's New York Times, Floyd Norris wrote about the changing economic forecasts that come out of the Congressional Budget Office. He wrote of the CBO forecast that they have seen enough of a slow economy to begin to think that we should get used to sluggishness. And he also expressed concern CBO's forecasts shape what happens in Washington. What's your take on CBO assumptions and the models that they use to reach their conclusions?
I think they're very mainstream, and I think there is some evidence that the potential growth of the U.S. economy is going to be slower going forward. I don't think by much, and I wouldn't want to overdo it, but by some. And I think in particular, we've seen a 30-year decline in where interest rates are, especially in real terms, which I don't think is going away. So I think the new normal is going to be lower interest rates and a little bit lower growth.
Constance, I'll give you the last word, about 20 seconds. Next Friday, the February employment report. What are you expecting?
I'm expecting it to be fairly weak, and in large part due to the weather effect.